Good morning. This is Dylan Giovanni with Behind the Markets. Happy Tuesday. Today's Tuesday, August 25th. And I've been thinking a lot about an expression I learned when I worked on Wall Street. The expression is this: if you don't buy stocks when they look absolutely terrible, you will never buy a bargain. And what got me really thinking about that is the housing market. See, U.S. home buyers are on a buyer's strike. And these numbers are really interesting. I wanted to share with you here. There was an estimated 51.3% more home sellers than buyers in July, which means that for every 100 buyers out there, there are 151 sellers. Okay, so you have a lot more selling out there than buying. That's the second highest level on record. And the percentage, for context, has doubled in the past 2 years. Basically, you have a lot of sellers pushing down the price of homes, really leaning into that. And this comes as the number of home buyers fell 2.5% month over month to 966,000, which is the lowest record of home buyers on record. Since they started keeping records, we have under 1 million people in this country looking to buy homes. That's the lowest on record. And it really speaks to the dramatic increase that we saw in housing prices after COVID. Remember, the Trump administration and the Biden administration sent out checks, just checks to people during COVID, okay? Everybody was happy getting that check, but it caused inflation. People started buying houses. Now that really doubled basically the price of the average house in America from about $200,000 to $400,000. So that is now starting to adjust back down. Remember something: housing prices always have to approximate someone's income, the income in the neighborhood. So for example, when you go to the bank, let's say you want to go buy a house, the bank says, you know what? Look, you can buy the house, you make $100,000 a year. We're going to take 30% of that, $30,000 a year you could spend on a mortgage, okay? That's all you could spend on your housing costs, $30,000 a year. So basically, the house has to kind of approximate income. When the house price when prices in general don't approximate income, banks don't lend money for people to buy houses. You can't afford them, okay? So what happens is those prices of those homes start to drift down. And that is where we are right now. So when you look at 80% of major U.S. metro areas are actually now coldly buyer's markets. And that's led by Miami, South Florida, basically, where sellers outnumber buyers by 154%. So really, it's turning into a buyer's market, but you get the sense that the housing prices haven't gone down far enough yet. They're drifting down, but they haven't gone down far enough. And that's causing a lot of trouble. So where do I get the idea that if you don't buy stocks when they look absolutely terrible, you'll never buy a bargain? Well, on Wall Street, we call these counter-cyclical trades. And that's why you see people like Berkshire Hathaway, companies like Berkshire Hathaway. It's buying companies into the housing crisis, okay? It just bought Taylor Morrison Homes for $6.8 billion. It just bought shares, boosted its position in Lennar Homes by 30%, bought D.R. Horton stock. So what you see here is Berkshire Hathaway doing these counter-cyclical trades. They're going against the cycle because they're thinking, and by the way, Bill Gates just bought the Gates Trust, just bought $352 million worth of Home Depot. This is counter-cyclical positioning, okay? These are really strong companies. And when you pull out your view, when you actually stretch out your calendar, the distance, when you expect good returns, then a whole bunch of good things happen to you in the stock market. Now, when I say the general rule is if you don't buy stocks when they look absolutely terrible, you will never buy a bargain, I don't mean garbage stocks, okay? I don't mean garbage stocks. I don't mean stocks that have inconsistent earnings, inconsistent businesses. Because what is a company that has inconsistent earnings? It's a company with an inconsistent business operating system, okay? They're not really operating their business ideally. So what I'm saying is that argument, if you don't buy stocks when they look absolutely terrible, you'll never buy a bargain. That works when you're dealing with situations like this, when you're dealing with strong companies, run with good management, healthy balance sheets that are just weathering a crisis and that are conserving their cash and making high return on investment decisions with their capital. This is why smart money buys. It buys the wreckage basically before the recovery. So they are buying into this disaster because presumably they see around the corner on this thing and they see that the recovery will be very, very strong at some point. And it's not evidence that the housing bear case is wrong. It's just evidence that these stocks are so cheap. And when you pull them out over a 5-year period of time, they're trading at a discount to what they're worth. Maybe they're trading, basically half of what they're worth. It's like buying $1 for 50 cents. So remember something, and this is one of the most important lessons I try to bring home on this channel here. Smart money buys the wreckage before the recovery. This is what counter-cyclical position when you're a long-term investor looks like. Going in, buying great companies when nobody wants them and when nobody is talking about them. And I thought this is just a great way to explain this very, very important lesson that you have to learn during your education as an investor. Anyway, that's all I have for you today. Have a wonderful, wonderful day. I will speak to you tomorrow.